This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I'm your host, Scott Meyers, recording live from the Inside Self-Storage World Expo, and we have in our booth now Herbie Bowman with StoreSpace. Herbie, welcome to the show.
Thank you for having me.
Yeah, well, it's our pleasure. We've had a great working relationship with StoreSpace, managing our facilities. Absolutely knocked it out of the park. Taken our NOI at our facilities and driven it up past our expectations, and couldn't be happier with the relationship that we've had. And so thankful that you have come on board in your capacity, because some of the stuff that you have going on and the new initiatives are going to be pretty interesting to the rest of the folks. So tell Storage Nation what you got going on over at StoreSpace and what your role is.
Oh gosh, well, my title is the Vice President of Strategic Partnerships. Basically business development, but we do so much more than just third party. So really, my role is to get the news out and let people know what we can do. A lot of our relationships start with a third-party inquiry, but we go a little deeper than that. And you know, sometimes we just provide the operations piece, and we're very good at that. Chris Harris and Rob Consalvo, as you know, started iStorage years ago and built it up, and got bored after selling it and decided they wanted to do it again. They are fantastic operators. But about 4 years ago, they started StoreSpace and quickly started hiring people that had the knowledge to build up a world-class third-party operations team. And so that's really where we started. We've got some really exciting stuff coming out soon as far as technology piece goes that will help us run your properties even better. But even past that, a lot of our clients will find out that we are open to things like potential JVs. You know, what I like to look for active developers that can come to me and say, well, I'm doing 3 or 4 now. I'd really like to do 10 a year. And I could do that if only, and then there's that blank. What we do at StoreSpace is try to fill that blank the best way we possibly can.
Well, we've my first introduction to both Rob and Chris, and then therefore to StoreSpace, was through some options for financing. I have a minority partnership in a portfolio of facilities, and we were looking to refinance. And one of my partners found Rob and Chris to talk about, discuss, some of the options and what that might look like. And the first foray was in looking at a joint venture. And so, as we talked through that, looking at multiple ways to be able to structure that in lieu of a traditional, just a bank refinancing or bringing in some other debt. And I'm just extremely thankful for both Rob and Chris and just the relationship that we've had, because now I've, through that conversation and so many others since then, I've recognized, as you just mentioned, there's many options that StoreSpace provides as services. You get your hands in a lot of things, and there's a let's call it a Consalvoism, I guess, if you could call it that I've used many times, and people have heard it on the podcast. And he said it's a math equation.
Exactly.
And at the end of the day, when we approach these challenges that we have in self-storage, in deal structure, in refinances, and most things, it really is. It comes down to a math equation. And so the conversations that we've had with what you've done with regards to, most importantly, the platform, the 360 platform, when I said, hey, we're looking to raise private equity in a different fashion, and I want to run this past you. He said, well, we do that. We built that, and we've got it on the back end. So let's talk about that more. So talk a little bit more about, the platform, and you don't have to go into the details about some of the offerings, but you're becoming fully integrated in many areas. So, speak to as many of those as you want to chat about.
Well, I like to say that we are the most entrepreneurial company in self-storage. I was asked recently, what do you guys do in self-storage? And my answer was really, yes.
Yeah. Fair enough.
We will look at it. We will look at anything. We're well capitalized. We have some institutional capital, some different buckets where we can pull money from. We are not crazy with how we spend that money, though, either. Bring us the right deal in the right area, and something that offers us an opportunity to grow financially with partnerships, our footprint, all that. Yeah, well, we want to take a look at it, and we want to talk about it.
Well, we've had nothing but a good experience in dealing with store space. You see an opportunity in the marketplace. Every good entrepreneur sees an opportunity in the marketplace. Then if it's not there, you build it. And that's so aptly put that you said you're the most entrepreneurial, because if there isn't something out there that exists or doesn't make sense, you built it on your own and brought it in-house. So where would you like people to come to you? What things would you like to see them coming to you for? Or is it all of the above, as you mentioned?
It sort of is all of the above. And if you, well, I know you know Chris and Rob very well, but for some of the listeners that may not, Chris and Rob are great partners. They're a little bit different, but they both bring so much to the table. What I mean by different is Chris is really the numbers guy. He has a banking background, and he is brilliant in that, which is not really my forte. I'm a little bit more on the Rob kind of mold as far as, deals and ideas, that kind of thing. But every time I sit down with either one of them, I learn a lot. And one of the things, just as an example of the entrepreneurial type of things that we will look at, Rob brought up to me, I have not been with Store Space very long, but one of the earlier conversations that he had with me was, have you ever thought about buying other small management companies? I'm like, I'm interested. Tell me what you mean exactly. And he says, well, it's hard to capitalize on these small management companies. I mean, if all they really have, they oftentimes don't own a lot of real estate. I mean, maybe the guy that is running it and owns that management company owns a few properties, and that's great. So, but how do you really monetize those 30 to 60 day leases that they have? I mean, it's really a goodwill purchase, similar to if you bought, I don't know, a Subway sandwich shop. There's no real estate. You got this little operating business, and it's the cash flow. So he says, I'll bet we could find some people that are tired of getting those late night calls, or the call that I can't come to work because I'm sick, or my dog's sick, whatever. And we can take those headaches off of their plate, and we will pay them, because we are one of the few people really in the country, unless you're already in self-storage operations, we're one of the few that would want to do that and do see value in it. So, that's another thing on my bucket list, or my checklist, I should say, to try to get done. We are growing so quickly, though, however, I have had a hard time keeping my head above water, just as far as making sure that everyone is taken care of. We're growing rapidly. I've already added 2 people to my team, so we're growing. But and that comes along with some pains of its own. The growing pains are the best kind of pains to have, but they're still pains. Sure.
Well, that's my talk at the AISS show this year was on the great roll-up. We've been teaching people how to scale and grow their own portfolio. And then in our mastermind, we talk about people coming together as a force within this community and moving forward together. And at every step along the way, and many people don't realize this in the beginning, bigger isn't always better. But boy, economies of scale means so much more. And the larger you get and the more you look at the industry and in any business, when you can go into a market that doesn't have a footprint, already got a management company that's there, that has a district that has been created, and an area manager and a district manager, it begins to make more sense to be able to hire that company rather than try to build that out on your own, or take your existing property management company and move them into that area. Just the buying power with vendors across the board. But most importantly, the relationships that you have with the property management company and all that goes with that. If you've got a website up that's already gaining a whole lot of traffic and SEO in place and everywhere else, now you add another location to it, you are years ahead of the game.
Absolutely.
And dollars, that are not spent because they're already being spent and spread across the others. And so we're learning that lesson. And I guess I'm just saying that between you and I, Herbie, for everybody else out here to understand and recognize that, because I think so many folks, they don't realize that in the beginning, to begin to look forward and what that means to be able to scale and grow, or to partner with people that are already scaling on a larger level.
Right.
So, what would you say to that?
Well, I'm glad that you brought up the geography piece of it too. A lot of things are going through my mind as you're speaking, but one of them is the geography. We are currently, right now, mostly in the south and the east, but we'll grow anywhere. In Vegas, we have a property that is going to be under construction soon, so we want to build a district out of there and then use the Vegas area as a base. But we'll also do one property that is out there on an island somewhere if it makes sense. And what I mean by if it makes sense is it the right property? Is it going to be in a market that is able to grow quickly and that we can add more properties to?
Shortly.
We're willing to kind of bite the bullet a little bit if we need to on those costs to get that one property going to be able to grow out build it out more.
Let's take a little deeper dive into, the underwriting of these facilities and the team's approach to how do we underwrite these projects to ensure that we hit our marks and the rates of return for our investors in considered probably one of the most tumultuous markets that we've seen in self-storage and real estate in general.
Sure. So you don't need a massive team. We grew from the ground up, from having 2 facilities to running around and managing some of these facilities ourselves. So being in the trenches, I think, is an important piece where you don't lose fact of the ins and outs of the business at the ground level. There's a lot of guys out there who come in from different industries with big money, but they lose track of what it really takes to manage these facilities at the end of the day. So there's definitely some of that. And a lot of it these days with bigger money coming into self-storage, as well as the consolidation of some of the mom and pops out there, which is the majority of the industry. So one thing that we pride ourselves on is the ability to find deals. A mentor 10 years ago told me, you make your money when you buy it. So I keep that in mind. We're really disciplined when we find properties, how we purchase the properties, that we don't put too much debt on them. We don't overinflate what the potential rent would be in the future. Some of those things will cause you to look back and go, maybe I shouldn't have gotten that zealous on pricing or how I was purchasing, or I just needed something to buy, which a lot of people, big money behind them, are running into. And there's a lot of stories in the storage game out there that people have done this and flunked in the past. So we can also learn from others there.
But we have a lot of conversations with individual investors, our private equity partners that are coming in. And sometimes it's the first time they've invested passively in a real estate transaction or in a self-storage deal, or they're just new to using their self-directed IRA because all of their retirement money has now been shifted to a self-directed IRA because they may have lost their job or made a job change. And so we have a lot of folks that are look at the marketplace to see, where best to put their money to get the returns, either to replace an income or to supplement their retirement. And it can be tricky because there's a lot of numbers being thrown around that look very attractive. But the biggest question in everybody's mind is, how do I get to know these folks better, like them and trust them, as we call, the entire know, like, and trust path that people go on. And for those individual investors, that comes by way of, joining our list, taking a look at the Tricor Fund and the offerings. And, when they talk with our staff, we say, hey, watch a few of these come out and, take a look at the returns, and, we'll cue you in on to some of the other projects to show you what the progress is and the returns on those before you jump in. That way you can get a good feel for, who we are and what we do. And so it's pretty simple and pretty easy for somebody to get comfortable with self-storage, because we are an education company as well. And then to be comfortable with us. But then it's a whole different animal when you begin to start, raising more capital and doing bigger deals like we're embarking on now. And Scott, you're having those conversations with the family offices. So speak a little bit about, some of those recent conversations you've been having with the family offices and how they differ from the individual investors and some of the things that they're looking for before they invest with us.
Yeah, great point. I just got off the phone with a manager of a family office yesterday, and one of his big questions is, there's a lot of money chasing storage. What makes you different? And my answer to him was the ability to source deals and manage the process of taking on an asset, stabilizing it, and finding the value. And how do we underwrite it? How do we find the deals? How do we underwrite correctly? How do we underwrite conservatively? So one kind of nugget of advice is, when I see a pro forma from a syndicator and there is a baseline of income that the asset's currently making, and then you look at that pro forma, the 1 to 5 year pro forma, and you look at it and you see these other things, other income coming in, ancillary income streams, but it's massive, right? The property nets 300,000, and all of a sudden in year 2, it nets 500,000. And they have these couple line items of other income, and they go, well, we can, start a U-Haul franchise and make $50,000 a year. And then on top of that, we can bring in Cruise America and rent out RVs. And on top of that, we can sell merchandising, and we'll bring in another $85,000 or $150,000 a year and additional income. And so some of those things you got to watch, because they take time and money to do. They're management nightmares. And they sound good on paper. They sound good in theory. And of course, U-Haul, Cruise America, and some of these other vendors talk it up to make it sound great, right? So that's just kind of one nugget that we watch is we don't overinflate the additional income streams. Those are the value add. We don't underwrite to value add. We underwrite to buying solid assets and solid locations with solid businesses, or businesses that we know can become solid in very short order. We know we can turn around a property in 6 months to 8 months to maybe a year tops. It shouldn't take more than that. because a lot of times we're buying mom and pops that aren't managed correctly. Expenses are through the roof, 40-50%. So I just watch those on the other income and then watch your expenses to make sure you don't think that you can be at a 20% expense ratio, big property that has massive payroll, and maybe you've not underwritten enough there.
So I guess this falls in the realm of underwriting because we do have to include property management, which is one of the largest pieces. And we could go a number of different directions with this. But, Scott, you from a company that's self-managed to then using third party to quasi self-management again with oversight. It's that age-old conversation that we continue to revisit. Speak a little bit about the evolution of that and, maybe the final direction that, that our fund is taking right now with regards to third party management with oversight and what somebody may want to look for when they're looking to either syndicators or even getting into the business on their own with regards to management?
No, great questions. I think it's important to self-manage in the beginning if you're equipped to, right? If there's somebody that can do the job better, cheaper, maybe it's worth it, but it's all about your business plan. So there's no real, ready-made fit for any one syndicator or investor or general partner. That's the fun of this business is we can be very creative and put together all kinds of different scenarios. And that's one love of this business of mine is the strategy that goes into setting up deals, setting up partnerships. That's the fun of it in my book. The properties are fun in and of themselves, but they come up with the same headaches that all properties have. So at the end of the day, we can structure all kinds of different deals, and that includes different management styles, right? Or management methods. We find that asset management is the most important for us because that's where a lot of the strategy of the asset comes in, right? That's what we love. So that's what we're good at. And that's what we focus on. And so I share that same advice to anybody is figure out what your passions are in this business. Riches are in the niches. You find your position within an industry and within a certain skill of that industry and just go at it. You can hire out your weaknesses and that's what we've learned to do. But, education at the end of the day is probably most important to really know what you need, what you're good at. If I wouldn't in the trenches, understanding all these pieces and parts, I wouldn't know that I didn't want to do property management and that I just wanted to do asset management and, run funds. And that's really what we're doing now. So continue to evolve and learn and figure out where your niche is and then stick with it. If self-management is the best way to make sure you can steer that ship and you have a creative property that takes some creativity, well, maybe a third-party property management is not the right scenario for that property. So just as well as it's a business plan for your business, it's also a business plan for the property. No property is the same. Every property is its own creature. And so you got to look at every property as its own business as well as, fitting that into your bigger plan.
All good stuff and all lessons learned over time from doing both sides of the house. And, ultimately it is what is best for the individual or the company. There is no magic pill to making all that work. And Scott, you touched on, the riches being in the niches and self-storage is, you could call it a niche within commercial real estate, although it's a very large piece of commercial real estate. But one of the niches that we've been fortunate to really kind of be drawn to now is boat and RV facilities, specific, not just only adding boat and RV or having a facility that has that, but facilities that are specifically boat and RV. And we're seeing a greater demand for boat and RV storage because it's more difficult to get zoning for it. There's a whole lot of folks during COVID that couldn't go on vacation or travel anywhere. And so they bought RVs, and there's still a backlog of our RVs that the manufacturers are trying to produce, and they all got to go somewhere. And so we've been fortunate to be involved in a few of those. And we also have investors that are wanting to either buy them from us or invest with us in those projects as well. So maybe give the folks a little insight into how you're approaching searching for them, the marketing for them, what happens when we find them, and how we go about fulfilling the needs on both ends. For us to have in the portfolio and in the fund for investors, and then also to feed the market that may want to buy them from us.
Yeah, it is a little bit different of a business model. So we know that. We keep cognizant of that. One thing I learned early in the RV and boat storage industry about 5 to 6 years ago when we started buying those deals that had exactly that and not mini storage is, they don't have hard assets on them a lot of times. They may have some covered, so lending can be a challenge too. Insurance can be a challenge. If you raise rates too drastically, they'll just pick their stuff up and get out of there. They don't have to clean out a unit. So there's definitely some particulars about that side of the business and that niche. But once you understand those and you play to those and make sure you mitigate your risk there. I think it's a great little subsection of storage. We're in the markets where it's a good property type, it's a good product. And one thing that we always look at is how do we improve? How do we continue to add rents to the bottom line? How do we manage these properties? How do we manage the rate management of it? Because it's a little bit more sensitive there. So that, there's definitely some nuances, but there's also a lot of big money coming into RV and boat storage. And that's all within the past year and a half, I could tell.
So let's do this. Whether we're in the year 2000 or 2008, let's talk about the general framework to, recession-proof somebody's personal income. It's the simplest, and it isn't rocket science and doesn't need to be, but for some folks, just sitting down, they haven't. They've shied away from a budget, and they haven't just sat down at the table to find out what are our expenses, what's our break-even point, what is our nut that we have to hit every month to be able to keep the lights on, stay in the house, groceries, and everything else that needs to happen, even outside of any other investments. If you haven't done that, folks, I strongly encourage and recommend that you do that. I've taught Financial Peace University, Dave Ramsey's course, for a number of years within my church, and it's amazing to me how many people in their 30s, 40s, 50s, 60s that have never sat down to see where their money is going. And
we're never taught this stuff in school, Scott. That's the reason why.
And that's why. You're 100% correct. And so all it takes is to have somebody show you how, but really all it takes is the gumption to say, all right, it's time to look under the hood of my own finances and find out exactly what this looks like and start telling my money where to go instead of it telling me where to go. But let's build a general framework because, as you mentioned, and I firmly believe, we don't know exactly what this next economic cycle looks like. It's going to be a recession of some magnitude. We don't know what and how it's going to differ. It's going to be different than 2000. It's going to be different than 2008. They always are. But how do we get people prepared for those folks that are, maybe a little anxious? They're in a sector of the economy that is feeling the pinch right now, and they maybe have something in the pit of their stomach that makes them think that, I may not be as safe as I think I am right now. What are some of the steps that they can and should be taking right now to recession-proof their personal finances?
Yeah, so there are lots of different things. I'm going to give some big, broad topics or things you need to do, but that's going to be so much more in-depth that you would need to learn in order to get there. But I'm going to hit on one specific one that I am very passionate about. So the other topics that we're just going to touch on, cutting expenses. Like we sacrificed, we cut out things because let's say get rid of Netflix or whatever it might be, because we knew all that money that went out was less money that we had to provide for a family. So
beans and rice, my friend. You just stay on beans and rice to pay off the debt.
Absolutely. On top of that, if you're cutting your expenses, getting out of debt, that's another huge one. If you have debt and you're going further into debt, get out of that hole. You're just making everything worse. So those are two big ones. Saving money, there's another huge one. Now, saving money, you can buy more real estate. Now you can invest with other people's money. It's a little more advanced, especially if you don't have experience. It's harder for people to want to invest with you if you don't know what you're doing. But all that stuff, we can get past that. But here's what I love. Now, when I first started thinking about being able to be financially independent, I was basically looking at saving a buck, is like a term, like saving money, but and cutting expenses. But there's only so much you can cut. There comes to be a point, and when you don't have much money, it's good, absolutely, 100%. You must do this. But it comes to a time where you need to start realizing, I need to start, instead of saving a buck, making a buck. How can I start making more money? Now, I'll tell you right now, I'm 42 years old now, and only businesses and only way that I make money, like investing, businesses and all that sort of stuff, the only way that I make money now is with passive income. We're not taught this in schools. This is what I really want to nail down. We're not taught this in school. We're not taught financial independence, financial literacy at all but even passive income, being able to work one time and make money over and over and over again. And if you remember back in 2008, there were so many real estate investors that went bankrupt. They were just gone. And I know of lots and lots of them that did. I did not. And the reason why, I made so much more money through the recession, through the crash in 2008. The big reason why, I was not investing for appreciation. I was investing for passive income. All the people that invested for appreciation, they literally went bankrupt because they were hoping and praying that it would continue to go up. It doesn't always go up. But no matter if the market goes up, the market goes down, or the market goes sideways, I still make money because I make money in passive income. Now, to add to that, because I was so blessed to be able to quit my job, just imagine if you had 40 plus hours of your life back in your week, every single week back to you, You can create more businesses. You can find new ways to make money. You just have that 40 plus hours of your life back. Now, I literally have 5 different businesses that make me money, and they all come back into my real estate. That's where I put all my money back into real estate. But what happens is all of it is passive income streams, because I'm looking at, okay, if there's going to be a recession coming, number one, get out of debt, cut expenses, increase your income, start saving for investing, and then start investing. But on top of that, what other businesses that you can work in your life to make more money that doesn't take more of your time? Because that's the only one thing we will always spend but never get back. We can never make more time. We can never spend money to get that time back. Your time is very, very precious. You want to spend it with your family. You want to spend it with your, serving your church, serving the people around you. That's what you want to do with your time. So your time is limited. You want to be as, not necessarily efficient as possible. You want to now work one time and get paid over and over again. That could be writing a book, selling it on Amazon, creating an awesome song. Now, I'm not good at either one of those, but I have written a book and it does sell. But if you look at other things like affiliates or affiliate marketing, where basically you promote somebody else's product, they pay you money. You create a podcast where you have advertisements. You create a YouTube channel. You do things where you work one time and you make money over and over again. For me, I love real estate. That's why I called my company Master Passive Income. So when I was quitting my job, I had so many friends and family members asking me, how are you quitting your job? Like, what are you going to do? I said, well, I invest in real estate. The second question always comes, well, can you show me? I was like, oh, I guess. And so I just found out that I enjoyed, after teaching so many friends and family members how to do it, from there, I realized it's a lot of work teaching people one-on-one. Maybe there's a better way. So I created a podcast, YouTube channel, everything called Master Passive Income, because I realized I buy one house one time. I make money over and over again, and I'm creating generational wealth. I will literally give the knowledge and the properties to my kids. And with that, I am able to now, not work a job, but in coaching all this stuff, it's made me so much more appreciative of all the blessings that I have. So now with this generational wealth, I am literally going to be able to take this passive income every day of my life and then give it to my kids every day of their life. So what biggest thing that I want to round out by talking about passive income is learn more about different ways that you would be good at creating passive income. It could even be, and I just created another business called the Real Estate Wealth Builders Conference. Scott, you mentioned it in the beginning. So it's a conference. Now, that's a lot of work. There's a lot of things going on in the conference. But here's the great thing. It's passive income because I hire employees. They're the ones that actually do all the work, and I just reap the benefits. Same thing with investing. I hire, when I invest in real estate, when I buy rental properties, I don't want to work, like if you heard the book, The 4 Hour Work Week, well, in my opinion, working 4 hours a week is for suckers. I don't want to work 4 hours a week, not even a month. I maybe work 30 minutes a month just by looking at my property management statements from my property managers and setting aside and going back to work, because I've built the business. And if you hear me at any length at all from anything that I have, you hear me say over and over again, and Scott, you would definitely agree with this, build the business first before you buy a property. A lot of people will say you buy a property and then you spend thousands of dollars to buy the property, then spend thousands of dollars to fix it up, and then find a tenant and then find a property manager. We don't do that, or at least I don't teach that. I teach we build the business and then we buy inventory to put into that business, and then that's a passive income business. I'll give you a quick example and then I'll let you, you probably got some questions, Scott, but here's a quick example. If you're going to create a convenience store, you're not going to sign a lease on a location, open the doors, and set a box of candy bars in on the ground. No, you'd go out of business in like 2 seconds. What you would do, though, is you would build the business first. You'd get the gondolas, those are the shelving units, all the candy bars go on, the countertops, the cold storage, the fountain machines, bank accounts, cash registers, insurance, employees, everything in the business before you bought any inventory. Same thing with real estate investing, in my opinion. We build the entire business first. And every piece of property that we buy, it's a piece of inventory that we put into our business, because our business takes care of that. That's how I was able to scale my business so fast, is anytime I bought another property, I just put it right back into the business. So my suggestion is, if recession coming, learn passive income streams, learn what you're good at, and then apply that in, but also add to that, just like with Scott, we want to put all those passive income streams into investments like residential, 4 units and below, syndications, Airbnb, self-storage, all these different great ways to invest your money to make even more money when the recession goes down. Remember, I said I make money if the market goes down, sideways, or up. And the reason why is because passive income keeps coming in every single month.
One of our development partners in a project up in Minneapolis, we built out a Class A 3-story self-storage facility, but it was built so that it could be converted back to any type, was not back to, but it could be converted into an industrial building of basically any sort, depending upon who wants to go in there. The multi-user can go in there. It could be a single user, just the placement of the elevators, the stairs, the construction type windows, everything that we built into the design of this. It's built for self-storage, but it could be converted. It seems to me, and we've been through this, we saw a little bit of this back in 2008, 2009. There's a whole lot of folks that came to that large industrial building that we had in the last recession where businesses were downsizing and folks were out of work. And so the entrepreneurs, or a business that, now they were half the size they used to be, or a third of the size that they used to be, and they were vacating their old leases or selling buildings, and they wanted these 5, 7, 10, 12,000 square foot spaces. The entrepreneur that's coming out of the garage or the basement, they want 1,000 square feet or these flex office spaces. Are we seeing, I believe that we're going to see that again as we head into this next recession. But do you think, Brandon, that some of the new construction, that it's going to be built in a way that it's going to be more flexible to be able to accommodate, to have movable walls, or walls that are so, easily taken out, where you can adjust the spaces and the HVAC that can then accommodate and go from space to space, so that you can essentially, contract and expand under one roof to accommodate the needs of the economic cycle and what's happening at the time? Does that question make sense?
It totally does. And it's a fascinating topic because, that's kind of a theme people have talked about. Storage used to be kind of a land play, Gen 1 storage would kind of be put it out there, you wait for some land appreciation. That's obviously changed where, we're building and buying a new development. $10 million is not a unknown number. Today's world, plus, you get in the market. So they're really focused asset classes. We experimented on one of our projects with exact kind of what you're mentioning of, do we design and build it in a way that it could be converted? And not to get into the minutia of it, but as the majority of storage, multi-story properties, projects and buildings, the structural load is carried each floor down just by the unit configuration itself. So there's, in contrast to conventional multi-story buildings that have columns and beams spread out, storage is a bunch of tiny toothpicks holding up each floor, structurally integrity, things like that. So traditional storage is on a multi-level nearly impossible, or cost prohibitive, I would say, to convert it after the fact. So it sounds like you explored it. And so we looked at one project. Do we build it on kind of column and beams where someone or us could come in the future, gut it, and convert the use? The challenge we found was, in today's environment, you kind of hit on it, like, to budget a development project is more challenging now than ever because of all the uncertainty and I'd say price escalations. We are really yet to see anything going down. It's just a question of how much things go up. And in developments, it'll take us, on a very efficient process, it'll take us a year to develop. But more than likely, that's 16, 18, 24 plus months to develop. And then call it a year to build. So our development yields are getting less and less than they were a few years ago. 6 years ago. And it's funny, I talk to people who are like, oh yeah, I'm building it. I did one 2 years ago, and I'm going to start another one. I'm going to build it for X dollars per square foot. And if you're not actively in touch with where pricing is, people get sticker shock all the time. I had a guy who swore he was going to develop his for $65 a foot again, because that's what he did 2.5 years ago. And I didn't necessarily want to burst his bubble, but that's going to get you maybe 2/3 of your project. Pricing has just gone up. So I saw that we had a really tough time penciling the current self-storage business pro forma, because what we found is, to build it where it has future flexibility, there was quite a bit of incremental costs. And so our storage pro forma, and we work with private capital and conventional lenders, our storage pro forma was having a hard time absorbing those front end costs
Mm-hmm.
for a future potential conversion. So
Right.
we experimented with one. We're not doing it anymore. If we're dedicated to storage, we're doing it in that 3-story fashion. But I mean, I love the idea and continue to kind of chew on that. And one
Mm-hmm.
thing I will say is we acquired a few conversions. And I know you mentioned when we talked last time,
Mm-hmm.
you did too, where I think that lends itself to better future proofing
Yep.
with other space of either you just have room in your building you can reconfigure, or obviously a single floor is much
Mm-hmm.
different. If you need to wipe out 10,000 square feet of storage to convert to some other light industrial user, that's much more manageable. So
Yep.
I definitely see that happening going forward.
Mm-hmm. Well, it's already pull and beam, and you're getting it for maybe not pennies on the dollar, but certainly at a lower cost per square foot than building new. And so that's why it makes it that way. And so, we're just looking at things in a little different light. Out of necessity, one of our projects, we had to bring in office, something else before the city would allow it. And we're seeing that, several of our other developer friends are doing the same thing, whereas a building won't work or a building is not going to be permitted as a use for storage 100% in this downtown area. But if they put retail on the floor level or some office or a combination of those, but then they can put storage, on the stories above. And that's what we've been looking at as well. And so I think we're going to see more of that, both out of necessity, but also, as our economy changes. I think we're going to see some more blending of storage, and hopefully those projects will work. One of the other things I want to touch on that you mentioned, Brandon, is how do you position yourself, to work with an NSA, to work with some of the larger REITs or even the smaller REITs. I know you have to be 100% storage, and they want clear focus. There's certain things that they want. Tell us a little bit about that journey into that partnership. I've known some folks that work specifically with a NSA that have partnered with them and that have sold to them. And they kind of go, they've gone in lockstep from the beginning to, define what the relationship's going to look like and what an exit strategy is. And of the folks that have just plain sold to them as buyers in the past. But it sounds like you're it's more of a partnership and in lockstep. So tell us a little bit about that journey and how that came about and what the relationship might look like if somebody is looking to find somebody to come along with them.
Yeah, happy to kind of share our story. It's somewhat unique, but again, back to like these trends or managing the process, because no doubt other groups, if are interested or can kind of probably find something similar enough to it. So for us, again, we started out heavy development, and then we started to acquire some existing self-storage facilities, kind of value add, low lease up deals. All working with a great private capital company that we work with, and we've had phenomenal relationships since the very first deal we've done. But all of those were with conventional debt on them. So as we went through and were accumulating these assets and our conventional debt, most of it, the vast majority of it was recourse, meaning that we're signing personal guarantees on the conventional debt. So lenders, as we come up with another project, they will start, and this will happen for anyone doing real estate, which again, real estate is a phenomenal business, but it's capital intensive. And for us, we didn't start out with a lot of capital. We were the boots on the ground. We're kind of the expertise, the grinders. But so we've raised capital and working with lenders. I love the day when that's not an issue. We'll see if that ever happens. So we would go to them with the next project, and they say, yeah, it looks good fundamentals, but they have what they call just global underwriting, a whole real estate summary of what you own and really your contingent liabilities. How much debt are you signing on? And we're getting to a point where it was kind of maxing out. I mean, lenders just have certain thresholds of what they're comfortable lending any given person based on their balance sheet and personal net worth, et cetera. So early on, we would sell an asset or two a year to the open market. And we've sold to Public Storage. Those guys over there are great. We sold to some other private equity groups. I know you're active in the industry and transacting as well as others are right now. It's a very active time. So we would sell to recycle not only our capital, because again, there's a certain constraint there, but really recycle our debt and our personal guarantees. So even starting out, I mean, I'm a big believer of like start with the end in mind. Like, if you want to be somewhere in 5 years, 10 years, you understand where that is, and then you work backwards. So we always had a strategy of we wanted to do some type of roll up exit with a portfolio. Now, we didn't know what that necessarily would look like, who it would look like, what type of partnerships it would be, but we did have that in mind of let's build up this group of quality assets with kind of quality partnerships involved, and then let's figure out what we want to do with that, knowing that we're just going to kind of pay it forward with new capital and debt. So over the last couple of years, we have brought in another partner to our GOS development company who actually had a background in corporate storage America. And so brought some really good insight of some of the opportunities that we could have.
Most of the folks that are listening to this podcast are familiar with 1031 tax deferred exchanges. They've been through them, or at least have heard of them and understand the basic mechanics. So we don't have to go into a lot of detail on that. But on the front end, we all know that the best time to be thinking about your exit strategy on a particular project, a real estate investment, is when you're buying it. And that goes into how we structure it and the timing of everything. And many people don't prepare for the exit as much as they should. So we've got a project that we're getting ready to embark upon, and we're not exactly sure what our exit strategy is yet. What are the considerations as to, should we be setting this up to exit using a 1031 tax deferred exchange or a DST? And then how do we approach those? What are those differences and how do we approach that?
Yeah, I'll start there and let Jake kind of fill in. So first thing is clarifying how and where you want your wealth invested, right? Not only your wealth, but your time and your energy, your stress, your location. I like to say the deferred sales trust, there's a concept of, financial freedom, right? But there's also a concept of time, energy, and stress freedom. And then also it's called entrepreneurial freedom, where you have the ability to go back in and start business or buy business or buy real estate or invest in real estate at what's called optimal timing. So defining where it is that you want to be, and then defining the greater macro industry, what's going on right now. And I can't help but think of what happened in 05, 06, 07, and 08. Not that I think it's going to be a crash for real estate like 08 was to 2011, but looking at what happens if your wealth is to change, and is there a better way to diversify and get some liquidity? And in fact, there's a cool stat that I think your audience will appreciate. And in fact, it's known as the largest wealth transfer in the history of the planet. So the American Bankers Association, a bunch of others have done a bunch of studies, and it's estimated to be something around $32 trillion, Scott, that's going to pass from the baby boomers to the millennials in the next 20 years. And in fact, there's 10,000 baby boomers turning 65 every day. And there's about 77 million in the US alone. And 50% of the total net worth of America is tied to commercial real estate, private equity, which is businesses, and primary homes. And those are illiquid assets that have huge, huge appreciation. And so the question is, how is that 32 trillion going to transfer? Is it going to transfer in a tax efficient way or tax deferred way, or perhaps in a stepped up basis way, inside or outside the taxable estate? And so what we're in is a battle not only for individuals who are looking for some freedom with their taxes and their deferral and their wealth, but also the grand big scheme of things of where and how this wealth is going to be. And so part of what Jake and I are on is a mission to help keep the wealth in the entrepreneurs, in the owners, in those who have invested for all of these years, versus passing it over to a government that's just say not very efficient with the capital. But at the end of the day, this does help the government because it creates macroeconomic movement of the funds, which creates more jobs and more cash flow, more tax revenue. So it's actually really a good thing, which people got to be aware of as well. And so how do you determine if a 1031 is good? Well, first of all, 1031 only qualifies for investment real estate. So if you're not selling anything but investment real estate, you don't even qualify. So if you're selling crypto or a primary home or a business or captive insurance or artwork or collectibles, a car or whatever, something that's like an exotic car, it doesn't qualify for a 1031. So 1031 is blockbuster because it only qualifies for investment real estate. Whereas the deferred sales trust is Netflix because it qualifies for any asset. As long as $1 million net proceeds, $1 million gain, that's our minimum. So that's the first thing. Number two, if you can find a quality property that you want to buy, guess what? You don't pay us a dime. You just do that 1031. Congratulations. However, we can be a backup plan for a failed 1031. Make sure you're working with a qualified intermediary that will allow both options, not one, because there's those out there that don't want you to know about this. In fact, most commercial real estate brokers either A, don't know about it or don't want you to know about it because they want to keep you in the 1031 transaction cycle. 1031 exchange companies, some of them don't want you to know about this, right? Some of them, they all accommodate. So make sure you're working with those that will allow that. But if you can find a value add forced appreciation deal that makes sense on the cash on the upside of the deal, by all means, buy it, but we'll be that backup plan. Jake, anything to add to that?
9/11 occurred. I was in school and the English teacher pulls it up on the TV and it's almost like, I mean, this can't even be real, right? But the type of community I was raised in, everybody pretty much joined the volunteer firefighters, the local police force, or the local National Guard, right? Anyway, so 2 weeks later, we all enlist, like a whole bunch of buddies. That's just kind of the type of community that I was raised in, the type of person that I am, right? Served my 8 years there. But being in the National Guard allows you to go to school and continue your education and everything else. I'm in my finance classes while simultaneously getting my securities license to handle assets in the market. And 2008 occurs, right? So another big, tremendous event. And my financial management teacher pulls the TV up. You've got people in Wall Street jumping out of windows. So, wow, this is the industry I'm going in, right? And again, we buckle down and we stay the course. There's a lot of other students who are shifting gears and saying, hey, I'm going to be a financial controller. I'm going to be doing all these other things. I'm going to stay away from the market, right? But what I've always found to be incredibly important is that when there is a crisis or when there is something insurmountable or when there is a big problem, you don't run away from it. You need to face it head on. You need to find a solution. And that's one of the great things about people such as Brett as a trustee is he's a solution guy. And that's why we probably align so very well. In regards to these highly appreciated assets that individuals are selling, a lot of times they're being forced solutions pre-made by other people, like a 1031 that may or may not be the best fit. A 1031 can, under very certain circumstances, be the very best thing. But at the end of the day, in regards to your question, Scott, I'm finally coming around to this right now, is that people need options and they need control over their timing. What could be the very best thing? Well, shoot, if a 1031 works and it might be the very best, let's do it, but let's use a qualified intermediary that allows for other options like a DST, a deferred sales trust. And let's be the backup plan in case timing doesn't work out, right? If you don't identify that next property within 45 days, and if you don't deploy those funds within the next 180 days, and things, if you're selling in a high market, does that mean that you also have to buy in a high market, right? So if the Rubik's Cube doesn't align under the 1031, under real estate only transactions, under the like kind rules that were broadened in 2018, whatever, right? Let's look at what gives you the most control over timing. Should you receive the funds inside of the trust and you want to reinvest in real estate? Well, you can wait 2 years. There's no problem with that. In the meantime, we'll do what we call corporate management of your assets, invest them in marketable securities or other areas, so that until the opportunity of that next good deal comes along, we're doing something active with your assets. We're not just letting them lose purchasing power to inflation. There's a number of different things that we can employ to help you during that time. I had the great opportunity while I was in school during all of this calamity that was going on, while working full-time in school, typical American story, right? And I had a professor, Stephen D. Harrop, 24-time Lipper Award winner. What is that? A Lipper Award is, hey, you're a fund and comparing yourself against all the other funds in your class and all the other managers who are managing those funds, who does the very best? And to receive that once in your career is a phenomenal thing. To receive it 24 out of 25 years of your career, I mean, there isn't anybody else like him. And he decided to retire and then teach school 2 days a week, whatever, right? And so I took classes from him. And he would literally say, today I'm taking my shirt off and I'm going to talk about the scars on my back, right? And he would share with us those experiences and how to react appropriately and how not to just follow the herd mentality, right? And so there were a lot of different things that I pull from mentors like Stephen D. Harrop to help clients today understand, are we reacting kind of like a knee-jerk reaction? Are we reacting to the hype? Are we being methodical? Are we being analytical? Are we really leaving the back door open should something not work out? Are we considering all of our options? And again, that goes back to the military acronyms, right? DDE, deferral, deduction, exemption. Teeing yourself up with a deferred sales trust allows you to time when you do take your principal payments and might pay that tax in the future, that you can then set up other deductions so that your tax burden is less. And should it be available to you through a number of charitable giving strategies, what have you, we can also find some exemptions to where you don't have to pay that tax at all, which at the end of the day allows you to snowball your original investment. When I say snowball, instead of selling something and chopping it up to pay the various taxing entities, which, they have their own purposes, and I'm not arguing their validity or anything else. But if you feel like you could do more with your asset yourself in control of those funds, then let's retain those, let's defer those taxes, and let's reinvest with the bulk majority of your asset rather than net of taxes, just net of a few attorney fees. And, now you've got this financial tool that you can do any number of wonderful things with going forward as an entrepreneur, as an investor, as a business owner.
First of all, Jake, I was remiss when you mentioned it earlier. Thank you so much for your service to our country. I absolutely, on behalf of everybody listening, enjoy the freedom that we have in this country to go out and do what we do, to be entrepreneurs and to be in real estate or our chosen field. And that doesn't happen without the sacrifices that other folks have made, including yourself for your time. So I appreciate that. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.